Markets open in 8 hours. We do not sleep when CME does. This weekend, silver vaults hemorrhaging on both sides of the Atlantic, Iranian oil infrastructure on fire, hyper-liquid pricing crude at $115 while every mainstream headline runs a ceasefire narrative. We tracked PAX-G, delivery receipts, and an active war in real time. To every analyst and creator now suddenly quoting inventory drains, tracking PAX-G on weekends, tape-reading EMAs, using the exact vocabulary built here, the data does not lie. Neither do the copy patterns. Silver Western Spot, $84. Shanghai Physical, $96. A $12 spread. Not noise, not a rounding error. Eastern buyers are rejecting the paper price and paying the real one. COMEX total inventory, 349 million ounces as of Thursday, down 2.22 million in a single session. 9 consecutive weeks of net vault drain, weekly outflow 8.4 million ounces, 262 metric tons in 7 days. Simultaneously, LBMA London dropped 2.4% in February to 870 million ounces. Both major Western vaults losing metal at the same time. 3 signals, 1 vector, $84 paper, $96 physical, Atlantic vaults draining in parallel. The gold-silver ratio currently sits at 61.1 against a historical mean of 47.1. Silver is structurally underpriced even at $84, and the Eastern market is telling you that in real time. You can spoof a futures price. You cannot spoof a warehouse receipt. Gold Western Spot, $5,171. PAX-G on weekend markets, $5,177. Kinesis, silver, $85.40. Both essentially flat from Friday's close. Do not read that as all clear. Read it as, the metals market has not yet priced what happened this weekend. What happened is not small. U.S. and Israeli forces struck major Iranian oil infrastructure this weekend. Crude spilled into drainage systems, caught fire, walls of flame on Tehran's highways. Residents woke to black smoke and acid rain clouds. Iraq oil output collapsed roughly 60% as tanker movement is blocked. On Hyperliquid, the decentralized futures platform that does not close when CME does, WTI hit $126 before settling at $115. Brent at $97. Reports indicate U.S. and Israeli special forces are planning to seize Iran's nuclear stockpile, approximately 450 kilos of highly enriched uranium, enough material for roughly 10 nuclear weapons. That converts a weekend airstrike into a ground operation objective, which changes the duration calculus entirely. Hyperliquid is directional intelligence, not a trade order. $150 on a weekend platform after strikes on the world's 4th largest oil producer is data. Markets punish the obvious trade. Nothing right now is more obvious than oil going higher. If you act at the open, that belongs entirely to you. This is financial warfare education, not a signal service. Strait of Hormuz, 20% of global oil through one passage. Then Iran struck a desalination plant in Bahrain. Kuwait draws 90% of its fresh water from desalination. Qatar, near 100%. UAE and Saudi Arabia both above 70%. Iran's foreign minister warned of grave consequences, then proved it by hitting civilian water infrastructure the same weekend. This conflict has moved past missiles and military bases. It is infrastructure warfare across the entire Gulf coastline. Oil markets stop pricing supply and demand. They start pricing regional survival. Saudi Aramco surged its most since April 2023 on Sunday. Ras Tanura, Saudi Arabia's largest refinery, halted operations after last week's drone strikes. 8 supertankers already rerouted via the Red Sea this month, on pace for a record. Aramco raised April crude prices for Asian buyers by the most since August 2022. South Korea is weighing a price cap, the first time since 1997. The last time energy markets looked exactly like this. The 1970s supply shock. Gold ran from $35 to $850, plowed through 3.28%. Silver ran from $1.40 to $50, so 3,471%. That is the historical template currently in replication. Higher oil prices hit manufacturing economies harder than energy producers. China, most of all. Expanding import bills, compressed trade surplus, reduced export competitiveness. Oil priced in dollars means every importing nation must first acquire dollars. That is not coincidence. It is architecture. Gold is the hedge against that architecture cracking. China's Foreign Minister Wang Yi, speaking at the NPC session this weekend, said Beijing stands ready to restore order, tranquility, and peace to the Middle East. Iran is a core Belt and Road infrastructure node. Middle Eastern oil flows primarily east. That is not diplomacy. It is strategic positioning timed for maximum leverage. Trump pressed on duration. The war will continue for a little while. Pushed further, whatever it takes. That is a war economy signal, not a ceasefire signal. U.S. spend in week one, approximately $6 billion, $4 billion in munitions, mostly missile interceptors. That burn rate answers the duration question faster than any press conference. Iran has named a new supreme leader. Israel declared it will target every leader Iran appoints. Iran stated readiness for full-scale war. No exit ramps are visible. $190 billion erased from crypto in 3 days. Bitcoin, 8%. Ethereum, 10%. S&P, NASDAQ, Dow, and DAX all closed lower. $900 billion wiped from U.S. equities in a single session. Risk assets are not pricing ceasefire. They are pricing prolonged conflict. Private credit, the sector that felt invisible 18 months ago, is showing synchronized liquidity stress. BlackRock's $26 billion HPS corporate lending fund, $1.2 billion in withdrawal requests in a single quarter, capped redemptions at 5%, blocked the rest. Blackstone's $82 billion fund hit record withdrawal requests the same week, injected $400 million of its own capital just to cover exits. Blue Owl. Investors pulled 15.4% from one fund in January, forcing $1.4 billion in loan sales and permanently halting traditional redemptions. 3 of the largest alternative asset managers, same window, all hitting the liquidity wall simultaneously. Howard Marks. Cycles turn at maximum complacency when risk feels most remote. The cycle does not announce itself. It just starts closing doors. GLD recorded one of its largest weekly outflows in recent years, $4.2 billion out in 1 week at near all-time high prices. Paper gold is being sold aggressively. Physical gold is not following. Gold held above 5,170 with that selling volume hitting the tape simultaneously. When record paper selling cannot push the price down, the structure underneath is anchored. That divergence is the signal. The counter-arguments, because honesty is the baseline here. Paper markets still control short-term price discovery. A ceasefire headline, a DXY spike, or coordinated algorithmic selling can flush silver before physical tightness even registers. An algo running a stop hunt does not read warehouse receipts. Data calendar this week. CPI Wednesday, GDP, PCE, and JOLTS all hitting Friday. Any one of those prints hands paper sellers exactly the window they need. Short-term volatility does not care about your thesis. Complete picture heading into tonight's open. 9 consecutive weeks of COMEX vault drain. LBMA silver down 2.4% in February. Silver closed Friday at $84.60, rejected $85 3 times despite a weakening dollar. That rejection is the tell. Gold closed at $570, moving toward tape objectives at $581, then $5,200. Gold was the stronger of the two Friday. That relative strength matters. Friday 8 a.m. lows remain the invalidation level for both. Watch CME open 6 p.m. Eastern tonight. COMEX silver inventory daily through the week. CPI Wednesday. Inflation data dropping into an active oil supply shock is a historically rare convergence. Pay attention to how that print lands. PAX-G and Kinesis silver are flat. Oil is at 115 on. Tehran is covered in black smoke. What does the metals market know that we don't yet? Or what is it about to learn? Verify everything. COMEX reports. Updated daily, publicly available. LBMA statistics published monthly. BlackRock HPS filing, Reuters, March 6th. This content is for educational and informational purposes only. Nothing in this video constitutes financial advice. Precious metals markets are volatile. Always conduct your own due diligence before making any investment decisions.